Hey guys, today we're talking all things mortgage, low interest rates, and forbearance.
Hey guys, welcome back. Thanks for joining us. It's Cole, Kelly, and we have a very special guest and friend of the Bridge Group, Allison Celeste. Yes. I've been saying her last name wrong, and I probably say it wrong for the last, as long as we've known each other for years.
With Movement Mortgage. So thank you so much for joining us.
Of course. Thank you for having me. As always, it's an honor to be here and hopefully bring some tangible value for your audience. It's been a little while since we've made a video. So as Cole and Kelly said, I'm Allison with Movement Mortgage. I've been a mortgage originator for about 10 years now in the Houston area. And I'm obviously a fan of the Bridge Group and a great partner of theirs. So I'm excited to talk about what we're seeing in the market.
A hot topic right now, the extremely low interest rates.
Yeah, we've been in all of our market updates and everything really that we've been talking about to our sellers and to our buyer clients. The mortgage rates really have affected the surplus of buyers that we're seeing right now that we maybe wouldn't see because of the current low inventory of sellers, and it's still currently very low. But because we have sub-3 interest rates, and Allison, I'd love for you to talk to that. You're the specialist, you're the wizard with the mortgage rate. So just let us know, what does that mean, and what has that been meaning to the marketplace?
A lot of things. So I feel like we can't talk about it enough because people don't realize the impact that interest rates have on your buying power, on your affordability, and especially in today's market with just the overall state of the economy. We're looking at our household numbers more than ever before, which is why purchasing makes sense right now with such historical low interest rates. And so does refinancing. In an average year, our mortgage market sees anywhere from $1 to $3 trillion of mortgage origination as a nation. And this year alone, in the past 6 months, roughly, we've seen $6 trillion worth of mortgage origination.
Wow.
And no signs of slowing. So between purchases and refinances, people are wanting to take advantage of interest rates, and we're seeing them fluctuate anywhere from literally 2.25 on a VA loan that I just locked recently to 3% on really qualified candidate as well on a conventional purchase. So depends on a lot of variances. I mean, there's 25 different items that go into determining one person's interest rate. So that could be anything from, is this a purchase or a refinance? Is it conventional FHA? What is a loan product? Term, credit score, income, you name it, it's probably on that list, and it determines what your rate ends up being. But they're incredible and the lowest that I've ever seen in my 10 years in the industry. So
what do you say to people who ask, should I wait? Are they going to keep going down, maybe later on this year, next year?
It's a really interesting kind of thought pattern anyways. We didn't ever foresee refinances and low interest rates coming back again. When I first started in the industry, our interest rates were really low and we were doing a ton of refinances, and then rates spiked and they were starting to creep up into the 4s and 5s again. And I remember everybody in the industry saying refinances are gone, like they're gone, they're never coming back. And all of a sudden this year hits, and because of what's going on with COVID and choices that our government had made and the feds lowering the interest rates, you never know what that predictability is going to look like. And we are in an election year. So usually interest rates are also a little bit more volatile around these times anyhow. So rather than take the risk, it's better to kind of be conservative and get in while you can. And then obviously, if there is an opportunity in the future where interest rates do drop down lower, then we can reevaluate your mortgage situation and see if it makes sense for a refinance or that next purchase. But for now,
I don't know if our nation would be in a very good spot if they went any lower than
right. It would probably be a really negative sign. Like that's when we start looking at situations like Greece, when we start to have negative interest on loans, that's not a healthy sign. So right now where we're at, it's helpful for the economy because 30% of the housing industry drives the United States economy. So we're really kind of helping our nation in this time with purchases and refinances because of the low interest rates. But if they ever dip down much lower than this, then it would be a huge cause for concern.
Okay.
Well, and that's, kind of how I look at it. I mean, right now, if you are a buyer and you're that person that's saying, well, I want to wait and see if they go down anymore, it's like you're at the craps table and you're playing and you're, $100,000 ahead and you're like, I want to see if I can get any more. You're playing with, chance there and you're probably going to fail. So two things. You said there's 25 things, and I know that I want to go all the way back to that. That was very interesting to me because people ask me, well, my interest rate should be around this, right? I was like, number one, you're talking to the wrong person. Number two, I have no idea. Like it depends on your credit and blah, blah, blah. But 25 things to determine what your interest rate is going to be. Is that correct?
Yeah, so each mortgage company has what's called like a pricing engine that we use to determine our clients' interest rate options. And those 25 different items are pulled over from their application. And again, it's going to be your social, credit score. It's going to be whether, again, it's a purchase or a refinance. Purchases tend to bear higher interest rates because it's a brand new loan. There's no proof of payment involved here. So you're starting a brand new loan. So refinance to purchase is already a different variance right there. Loan type, are you going government loan? Because government loans, either VA or FHA or USDA, are either insured or guaranteed by the government. So those rates tend to be more competitive than, let's say, a private mortgage lending option like a conventional loan product. Is there a first or second lien, and the list kind of goes on and on and on. And all of that makes a difference. I mean, you can have two clients with almost the identical financial situation, but one variance can be different than on this client than the other client, and it will change their options entirely. And you have market level interest rates where it doesn't cost you or us necessarily to offer that interest rates. And then there's buy down options for either us or the client. So there's lots of options within that list of populated interest rates that are available for them. And it kind of just depends on what makes most sense for that individual client's situation.
So it makes absolutely no sense for someone to hear their friend say, I just got a 2.5 interest rate. And then they come to you and you give them, maybe a different answer or something that's not as favorable to them. And they say, well, my buddy just got, it's apples and oranges. It's
right. It's completely different. Yeah. And it, the loan programs definitely do play a big role. Grant programs, for example, when you start to look at down payment assistance, those entities that grant that money for down payment assistance set the interest rates. So we don't have any ability to compete or offer better deals because it's that entity that's giving that down payment money that sets that interest rate. So you can have a 3.5 on a grant program versus a 3% on an FHA program. And the difference is this one's bringing 3.5% into closing and has a vested interest in that loan already. And this one's bringing nothing into close as a down payment. So, there's lots of variances and just definitely something to keep in mind as you watch the market, because I believe that all of us kind of do as a whole. And then if you are in the market and you're starting to hear friends or family or, close members around you shopping for home rates, that it's not always apples to apples.
Okay.
In fact, it's probably never apples to apples.
Well, that's good. Yeah. And so then one more thing before we start talking about forbearance was election. You briefly talked on it. It is an election year. What do we foresee the interest rates are going to be doing at the, in the fourth quarter and first quarter of next year, fourth quarter of this year, first quarter of next year, as we're going through an election?
By all predictions so far, rates are going to hold through 2021, despite an election. And and there's not anything that's indicated differently. We're seeing a lot less volatility in the interest rate market as a whole than what we did when COVID first started. I mean, there was definitely a time there in which we would see really large swings in our market, different interest rate changes, intervals throughout the day, and we're not seeing that as much, which is a positive sign. We're kind of stabilizing a little bit more as our economy is starting to see some more cash flow and stability as a whole, and a little bit more growth and health. And I mean, the Fed wants our economy to ultimately recover, so they're not going to make any drastic changes just yet. So we're feeling good about it. However, again, you never quite know what's going to happen because it is unpredictable.
Well, yeah, if we haven't learned anything, or if we've learned anything, 2020 has taught us that you never know what's around the corner.
Yeah.
Well, let's go ahead and go into, speaking of recovery, let's talk about forbearance. It is something that everyone has heard of, but not too many people really understand what it means. And I think to many people's detriment, and maybe, another 2 or 3 months, they'll find out what it means whenever it's time to come up with 6 months or 4 months of house payment.
Yeah, definitely. Seeing a lot of that, and we did actually during Harvey too. I mean, this isn't new to us, except this time instead of a Houston level, it's a national level. So that's obviously what brings that kind of fear about is people not understanding when they went into forbearance agreements what they actually meant, because not all services are mortgage loan servicers are created equal. So they may not have gone through the actual terms and agreement. They just offered a package, and a lot of people opted in to it not knowing better, or because they're desperate for help, and we understand that as well. So, if somebody is in the position of being in a forbearance agreement, it's always good, even if you're in the middle of it, to call your servicer and really understand those terms at a deep level if you didn't get that understanding at the outset when you agreed upon entering that agreement.
I should have clarified it in the very beginning. What is a forbearance agreement?
So each mortgage servicer has their own definition of what that means. In a traditional sense, forbearance means that usually you have an agreed upon term, let's just say 3 months, that you are not going to make that mortgage payment. And then at the end of that period, that lump sum is due. And if you cannot make that lump sum payment, then they will typically break down that lump sum into your monthly mortgage payments over agreed upon time, maybe 6 or 12 months, which obviously means your mortgage payment goes up during that process as well. And that's in the traditional sense. Now, some mortgage servicers, their definition of it is that they were willing to treat it more as a deferment and take that lump sum and actually tack it on the end of your mortgage note so that you don't have a lump sum that's due. But again, it depends on the servicer, and we've seen so many different kind of definitions of that and approaches depending on the servicer.
But at the end of the day, forbearance does not mean forgiveness.
Correct.
3 to 6 months, you're still having to pay that, whether it's on the back end of it, whether it's in 3 to 6 months lumped into. So you're still having to pay it. Doesn't mean that it's just forgiven, and because of a pandemic or a natural disaster that you just don't have to pay it.
Yeah. These are million and billion dollar corporations. There's no such thing as forgiveness for them. They're trying to get their money. So, definitely if you have agreed upon any type of forbearance package and just didn't understand the terms, but we're looking for immediate relief, definitely dive into that a little bit more. Make time, because I know you're going to be on hold with your servicers for a while, trying to get through to a rep to understand what those terms look like. Get everything in writing. And then if you are finding yourself in the position that you're not able to make those payments because you opted into a forbearance agreement and a lump sum is due, or you've tried to make that increased monthly mortgage payment with that forbearance addition into it, and it's not feasible, they are going to look at foreclosure options. And that's the biggest thing, is understanding even what that process looks like. Usually once you get like a notice of default sent to you, that's after usually like 3 months worth of missed payments. And after that notice of default is issued to you, usually you have an additional 3 months to make that mortgage payment whole again. So you have a small window in order to reconcile that. And if it's unfeasible for you, that's when you start to look at, what does my equity position look like in my home right now? And is there an opportunity for me to sell this property to just break even, not ruin my credit, and walk away and just move into a different season of life temporarily until you can, readjust and get back into home ownership again? Or what would it look like to sell your home and maybe walk away with some equity as well?
Yeah. And so, we talked about this a little bit before the call and with our team yesterday, but there are a lot of people that we're working with, and they're probably around the 450 to 750 range, as far as that's the product they're looking to purchase. And they want to take advantage of these low interest rates, but at the same time, they're that person at the crap table trying to get lower and lower and lower prices, where you're already winning a historical low interest rate. But they're saying, well, we want a lower price on these properties, and in this competitive market with low inventory, we're just going to wait until some of these forbearance deals, go into foreclosure. However, when we were talking, it doesn't seem like that. Now, there are going to be foreclosures in that market, but the majority of them are probably going to be closer to the average price point in the Houston market, which is around that 280 to 335 range. Would you say that's pretty accurate?
Yeah, that's what we can anticipate. And I don't believe it'll be a large pop of foreclosures, because every servicer offered a different package. Some offered 3 months, 6 months. Some instances they offered 12 months forbearance agreements, which is kind of hard to wrap your brain around.
Yeah.
So I think that you could anticipate kind of a longer drawn out process of maybe foreclosures hitting the market, but it is going to be in that, to average price point, that 200, 280 price point and up.
Okay.
So if you guys are watching this video and maybe there's some interest in learning about where you're at in that process, there's maybe been some payments that you're kind of wondering about, definitely reach out to us. We can definitely give you an idea of what the value is in your home, the equity in your home, what you can walk away with, where you don't get in a situation like that. You can also reach out to Allison, obviously, to talk about what forbearance looks like, and your service provider will obviously provide a little more information for you, but you have people here to help you throughout the process, for sure.
And if you're a homeowner and you're not in that position, but maybe you're in a position to where you're paying a 4.5,
yeah.
You got your mortgage, 3-4 years ago, and you're paying 4.5 interest rate, and you want to take advantage of these historical low interest rates, talk to Allison. She can definitely help you out on refinancing, or if you say, heck, I want to sell this house and get another house at a lower interest rate, we'd both love to help you out with that.
Well, the cool thing is, yes, you can get a lower interest rate, but the prices are at historical highs in terms of the sales values in Houston. So it's kind of a great win for sellers all over Houston right now.
Right.
Well, thank you so much, Allison, for joining us, always providing lots of value to our clients in our database. So thank you again for joining us, and reach out to Allison or to us if you have any questions.